The Santa Claus rally officially kicking off today. That's the last 5 trading days of December and the first 2 of January that historically bring a market rally. Joining us now, we've got Jeffrey Hirsch, Stock Traders Almanac Editor-in-Chief. You say that the odds are still in favor of a Santa Claus rally here. Why is that?
It's not just that the odds are in favor, it's that it's an important time of the year for us to take a check on the market. It's not necessarily a trading rally. It's really an indicator. It's the first indicator of our January indicator trifecta. Santa Claus rally was created in '72 by my illustrious father, Yale Hirsch, who started the Stock Traders Almanac. And it's really important if it doesn't show up. So he coined the phrase, if Santa Claus should fail to call, bears may come to Broad and Wall. And then if we get the first 5 days down, the January barometer, which he also created in '72 down, then we're looking at some issues. But the recent selling that we had in December, very typical, early December, profit taking and tax loss selling, kind of sets up, it took some froth off the market, kind of sets up the potential for a Santa Claus rally. So it's not so much that I'm so pumped to trade this rally. It's something I'm really watching to see if the bull market's got some legs, and if we get some breadth, some broadening of the market, and a positive Santa Claus rally. That's the first step to confirming the bulls got room to run.
Let's say, Jeff, that didn't happen. The Santa Claus rally, it didn't show up. We had a failure there. Historically, Jeff, that precedes what in the market?
Times when stocks can be purchased at lower prices later in the year, bear markets, weakness, flat markets. It's generally better when the market's up about 6.5% when you get the market down there, but it's up much more when the Santa Claus rally comes in. But it's just one indicator. Santa Claus can be down like it was in '24, but we had a full year January barometer gain, and that was kind of the clincher for us that things were okay with the market. That's why we stayed bullish in '24, and I don't think we're going to have as much gains in general in 2025, but getting a positive Santa Claus rally will be encouraging that the bull market's got some room.
Yeah, what is that outlook for 2025? I mean, we've heard a range of predictions here, including, but not limited to, of course, a potential correction in the first half of 2025.
I think we've got the potential for some correction in Q1. It's very typical in post-election years, but my overall outlook is for gains about 8 to 12% based upon the post-election year history of 5 years of presidential terms and combinations of, the long-term history going back to 1950 with our aggregate cycle of all years and 5th years. But economics are looking pretty strong. GDP, job market, there's some positive. I think the Fed's on our side as well. Technically, we've seen some correction here, a little overvalued, but I just see this tech boom, this AI macro trend continuing to lift the market at least through 2025. 2026, I'm a little bit concerned about. That's a midterm year when we were notoriously prone to corrections and bear markets and recessions. But right now, everything seems to be just pretty resilient in the U.S. economy. Be nice to see some broadening. I'd like to see some breadth and some new highs. Sort of confirm that there's more to the market than just the Mag 7 or the Qs.
So you mentioned breadth, Jeffrey. What else might be on your wall of worry there? Would it be valuation, sentiment, positioning?
Inflation, the 10-year. If we get some more month-over-month inflation, that's going to give the Fed some pause, and the market's going to worry about getting, it already got walked back. They reset the expectations, but inflation and the 10-year are really what we're looking at. Sentiment, bullish sentiment can go on for a long time, as we've seen here. The real indication of sentiment is when it's really bad, like we had in October 22 when there was no bulls except me and, a couple other people out there, but very few. So bearish sentiment is a contraindicator, much more so than bullish sentiment. And I think, we can catch up to the valuations with earnings and growth, but really inflation and the 10 years where my concerns lie.
I wonder what you kind of analyze around this number. 25% of consumers expecting the stock prices to decline, up from 21.7% in the most recent consumer confidence reading that we got out to begin this week. How does that really play into the mindset of the retail investor that is trying to figure out how to position their own wealth growth?
I mean, what really drives the market is the institutional investors. So having some bears pick up in consumers and retail investors is encouraging to me. It's what the big money is doing is what really drives the market. So some nervous individual investors is fine. I encourage people to not make any rash decisions at this time of the year. When we get into the end of the best 6 months, another creation of the almanac around April, May, the end of NASDAQ's best 8 months, that I think will be a time to reposition and take some profits and readjust portfolios. But right now, I don't think there's any reason to get skittish.
All right, we'll leave it on that high note. Jeff, thanks for joining us today. Happy holidays.
Appreciate you guys. Thank you for having me.